Silver's kind of, silver bouncing a little bit here as well. It broke below this kind of channel a little bit here. So it's just below though, and you have so much support right here. So I'm actually bullish on gold and silver right down here. Yeah, I think for the most part, Ethereum percentage-wise was down so much more than Bitcoin, right? So if you look at almost 5,000 to a low of almost 800 percentage-wise, that was a massive, massive sell-off, as opposed to Bitcoin, which was a big sell-off as well, just not as much. So it makes sense that, that one beaten down so much is going to get the bigger bounce. It also tends to lead. Sometimes we've seen altcoins lead. It's a perfect example of risk on, right? I mean, the altcoins are definitely the risk on assets. Bitcoin is more the old trusty commodity. I think the dollar strength has probably kept the Bitcoin chart down a little bit because, again, if you think about Bitcoins are traded in U.S. dollars or stable coins that track the U.S. dollar. So I think that's been one of the reasons why Ethereum, which is more like Ethereum, to be honest, is more like a stock in that it has a use case, right? It makes something, or at least it helps people do something, versus Bitcoin is just basically a commodity. In fact, Gary Gensler, I think this morning on CNBC, was basically saying that. He said, most coins out there are more like stocks versus Bitcoin more like a commodity. So I think the Ethereum is leading it like a stock bounce, while Bitcoin is kind of languishing because the dollar has been so strong. I do. So you've had these pause days here. Even today, Ethereum's starting to creep up. The first big challenge for Ethereum's at 1,700, this pivot low, this area right here, and all this sideways chop. And then if it gets through 1,700, I think you make a run at 19 to 2,000. So again, I would say if Bitcoin's going to go to 28 to 30, I think you probably get to 2,000 on Ethereum. And then again, if you only get to 25.5, then maybe Ethereum stops around 1,700. But in either case, I still have more upside here to go, as you'll see again, kind of almost like a nice little cup pattern here.
Yeah.
It's not quite a handle yet, but for the most part, it's a nice little cup potentially. And yeah, technically it continues to look strong until it gets into some of these resistance levels. Yeah. So I've been, the strength in the dollar surprised me a little bit. Now, granted, gold is still surpassing gold is only down slightly for the year versus, Bitcoin as well as the stock market. But the one thing on gold is overnight, it hit this major support line. Look at that support line here. And look at the bounce that you're getting in gold. It's really a tremendous bounce, basically $40 from the overnight low, which is a big move for gold. And so short term, that's a support level that I think you look for a further move up on. Minimally, I think you go back to about 1,785 to 1,800 on the gold chart. And then basically what I'm going to start watching is this trend line here, right? So this is probably, if you look at this pivot low here, we draw a trend line, notice how that's right almost at the same spot. So if gold rallies, that's going to be your resistance line right around, 1,785 or so. If by chance it can get through, that's where you start to have that bigger move up on gold. But right now, at least gold hit this major support line, and it held, and it got an amazing reversal. I mean, just tremendous kind of short squeeze almost off of those lows. Now, if we look at silver's kind of, silver bouncing a little bit here as well. It broke below this kind of channel a little bit here. So it's just below though, and you have so much support right here. So I'm actually bullish on gold and silver right down here. Both are into major support. I mean, look at this chop going back to 2019. All this sideways, this was your COVID drop. But if you took that out and you just assumed sideways, then it was just before the big breakout. And now you've done a full retrace to the pre-COVID highs. And I think that's, again, a major opportunity for silver as well as gold. Yes, correct. And I think there's even some opportunities in some of the miners. I know you don't do miners much, but like I was picking up a little bit of AEM today. You can see this is a Nico Mines, and the stock has fallen from $66 down to about $40 on this decline in gold and metals, and just, it's begging to get a technical bounce here back to about 45, 46 or so. So kind of some interesting charts out there. There's not a lot that's, at a near-term low, but the mining stocks and gold and silver are really, at their recent lows here. I agree. I mean, this is something that really since the 70s and 80s, we haven't experienced. And I wasn't, I was born in 1980, but obviously I don't remember any of this. But I mean, it's also a different time in that I feel like you have a lot more, a lot of other factors that are troublesome as well. You have global instability. I mean, I guess you could say back then you had some of that too, but to me, it's a period in the market that most people have not dealt with the inflation side, and with the Federal Reserve being able to, or being unable to print our way out of recession.
So do you think that, because one of the things that I've been hearing other analysts say is that we're not going to see a bull market until we see Federal Reserve and other central banks reverse course, which would have to mean printing again, turning back on to printers. But you're saying that they don't even really have that. That's going to make everything worse. So do you see the Federal Reserve reversing course in that aspect?
So what I would say is that I do see the Fed reversing at some point. So think of it like a scale, right? And I always like to use this analogy here, or this example, where right now we have low unemployment and high inflation, right? So here's your inflation up here, here's your unemployment down here. Now, as the Fed tightens, inflation is going to come down, but unemployment, because the economy is forcing the economy to slow, unemployment's going to go up. When you get to a certain level of unemployment, let's say 10%, they're going to feel the political pressure and just the pressure in general to print again, which will then shift them back. So you're going to be on this scale back and forth. The problem is it's back and forth down here, and then it's just going to both rise up and up and up, because inflation's never going back. No, I shouldn't say never, but I don't see it going back to 2% or sub 2%. So when they start the printing presses again, it's going to have to be a really bad scenario, because inflation will still be at 5% or 6%. And then you're going to increase inflation to 15% or 20%. And you're really in this tough scenario. So you'll have mini bull markets where the market is going to be like, yes, the Fed's not going to tighten anymore, buy all risk assets. And then all of a sudden they're going to say, whoa, the inflation numbers are going to get really bad again. And then the Fed will tighten, and then unemployment will skyrocket again under the next recession. And there's really no outcome. So I have no problem going on record that I think the highs in the NASDAQ and the S&P 500 are probably like a decade high. Like, I don't think I could see us being in this troublesome period for like 10 plus years where we don't see new all-time highs on the stock market. It's hard, but let me get rid of this for now. I mean, this is a channel that I have, but basically, I mean, you could just see how ridiculous it is. So basically this is the market. This was the .com bubble right here, right? All right. So we all thought the .com bubble was the most, at least most people back then were like, this is the most ridiculous bubble in the world. And then look at the market after. I mean, this is more of a normal market. And then here's 2009. And then once the Fed turned on the printing presses, look at the market. I mean, this is ridiculous.
That's your QE 1, 2, 3, and then infinity.
I mean, infinity, right? And so really what you're doing is you're starting to pull back off of this infinity insanity. But if you go back to the markets over the pre-printing press, aside from this period here, which wasn't even that crazy looking back compared to this one, I mean, a normal market does not behave like it has over the past 10 to 12 years. It just doesn't. And so if the Fed is really going to be handcuffed, the markets are going to be in a kind of a quagmire where they're going to be much more prone to sideways or lower movement for probably years and years to come.
Yeah. No, people aren't going to be taking like risks and stuff like that. It's going to be very safe plays. Do you see like what could you see crashing the NASDAQ chart?
I could see, honestly, if you get a worst case scenario, I could see the NASDAQ revisiting the .com high here, which is also this pivot area. So that would kind of be a worst case, but you're talking like 48 to 5,000 on the NASDAQ. And I mean, that would be from almost 17,000 down. That would be an incredible. This is the tricky thing is that if you ask the average investor didn't really come into the stock market until like 2020, right? When the COVID lockdowns occurred and the government was sending checks, a lot of people a lot of Americans at least discovered investing again. They finally were like, okay, let me get back into the market. And the markets were awesome for like a year and a half until the top was put in. So the problem is that yes, like 401k money that's been consistently invested, pension funds, they're deep in the money. But a lot of individual investors, just like with crypto, they only got in the last year and a half, and they're already deeply underwater. And unfortunately, it's probably going to get worse. But we see this. This is what's so nuts, is that we see this every bubble in 2000, in the 2000.coms. The small investor got lured in like the year 2000, right at the end of the dot-com bubble. And then they got so burned that they said, hey, I'm not going to invest again. Well, guess what? The markets lured them back in 07, when it just seemed like anyone could make money. And then the next collapse happened, right? And then they were like, okay, I'm not going back in. Well, guess what? They finally came back in 2020, just before this top. So I mean, this is a rinse and repeat type scenario where the smaller investors, the John Q. publics, get lured in at the end of moves, because finally there's so much hype and money becomes so easy to make that they get in, but they're buying right at the highs.